All right. See, now this one works. Not only that, but it just automatically records. With the NYU one, you have to remember to hit the record button, and that's very easy to forget. And in fact, that's one of the reasons why I forgot that one time because I'm so used to this one, where it automatically records itself, and so you have to remind yourself, oh, that's right, this one is set up so you have to hit that button separately. So yeah, that's this is a better experience, but I figured I would use NYU's Zoom for NYU classes, and this is what happened. So anyway, so as you know, I did send you a couple of weeks ago a bunch of Excel spreadsheets because Brightspace is still completely worthless with Excel. So this week we'll need to do this more than usual, really, because there's a lot of statistics involved with this week's topic. And so we're going to be looking at risk management, the field of risk management, which heavily involves using derivatives for hedging strategies. But it also has its own unique way of looking at risk. Often risk can be defined depending on what securities you have in your portfolio. Just as a quick example, and this is one of the reasons for this framework I'm about to show you. Before, let's say back in the day, in the 90s, let's say, risk management was kind of a hit or miss proposition because risk is often measured with statistics that only apply to a single security. And let me just give you a quick example of that. For example, the risk of a stock can be measured with beta. Okay, now the beta is something that was developed with the CAPM model. You may have heard of this, the capital asset pricing model. Beta measures how much systematic risk a stock adds to a well-diversified portfolio. And I just want to mention that systematic risk refers to the types of risks that are common to all assets in the economy. Such as rising interest rates, rising inflation rates, slowing GDP growth, trade deficits, etc. Okay, so the CAPM model was actually developed in the early 60s. And the purpose of the CAPM model was to come up with an alternative framework to what we call modern portfolio theory. And modern portfolio theory, which came before this, uses the standard deviation of a stock's returns as a measure of risk. Now, that doesn't sound like such a bad thing, but the problem with that is that if you've got a portfolio with any reasonable number of stocks, even 10 or 15 or 20, calculating the risk of a portfolio with this framework can be unbelievably time consuming. And so what we've got here, this CAPM model, is an attempt to essentially change the way we think of risk in such a way that we can calculate the returns to stocks and the risk in a much more simple and straightforward way. The only problem with beta is that it really only applies to stocks. I mean, technically you could apply it to bonds too, but I don't know. It doesn't seem to work particularly well. But it's not particularly useful for other securities. And then we also have bonds, the risk of bonds. Now, I should say here, not the credit risk, but the market risk of bonds can be measured with modified duration. Now, if you haven't been introduced to that, it's not that important, but it's the modified duration essentially tells us how much a bond's price will change in response to a given change in market rates of interest. So basically, it's a sensitivity measure. If interest rates go up by 1%, what's going to happen to the price of my bond? That's what modified duration tells us. Now, here's the problem with these measures. While these measures work well, or let's put it this way, beta works well for stocks, and modified duration works well for bonds, but they cannot be combined into a single risk measure for a portfolio that consists of both stocks and bonds. Okay. In other words, you couldn't, if you had a portfolio and you had both stocks and bonds in it, you can't really combine the two measures to come up with a single number that tells us how risky the entire portfolio is. In other words, you basically are left with figuring out the risk of your stocks and the risk of your bonds, but you can't really realistically combine them into a single number, which is very unfortunate because this means that you can't take into account to incorporate correlations between stocks and bonds when measuring the risk of a portfolio consisting of both stocks and bonds. Okay, in other words, it wasn't possible to have a single number that applies to your entire portfolio. Now, I'm sure we could come up with other risk measures too for different types of assets. But the point of all this is that before what we're about to see came along, and when I say this, what we're doing tonight is this interesting framework called value at risk. Before value at risk came along, essentially risk had to be measured for each individual class of securities, and combining them was really not realistic. And so that was a huge problem because a lot of the risk that we see in financial securities comes from the way they interact with each other. So in other words, for example, if you've got a bunch of stocks in your portfolio that are all from the same industry, they're going to be highly correlated with each other. And so any downturn in that particular industry is going to have a major impact on your portfolio. Whereas if you have a diversified mix of stocks, then the impact of any one industry will not have such a big effect on the overall portfolio. So that's an important measure. So the value risk framework was actually created in the early 90s at JP Morgan. Now, a lot of what we're seeing in our course, a lot of the results we've been looking at were developed really by academics. Okay, a lot of the people who worked in these fields were college professors. So in other words, the CAPM was invented by college professors, and the duration, I think, was developed on Wall Street. The original version of duration was actually invented by an actuary who was studying methods for determining if an insurance company has enough funding on hand to cover all the claims against them. And you can imagine that's a huge deal for an insurance company. So, a lot of this stuff was done by research departments, but the value at risk framework was done at Morgan as a service for their clients. In other words, they made a lot of money by managing these companies' risks. Somebody would approach them and say, listen, I've got this huge portfolio of different assets and I have no idea how risky it is. So what they were doing here was they're saying, listen, we created this statistical framework that is relatively easy to implement, time consuming, but straightforward. And so the goal here, now here's where it gets interesting. The profits came from the sale of data to the clients, who were then able to implement value at risk on their own computers using Morgan's software. Or else, in some cases, the clients let JP Morgan do all the work, including they would send them their data. Here's our what we have in our portfolio. So it was a money making thing. They were trying to make money for their clients, but there was more than just that. One of the goals of this framework was to make it relatively easy to explain the risks of different portfolios to non-specialists. For example, management, upper level management, people who are like accountants and they don't really know anything about this stuff. And so they could say to them, listen, here's what our portfolios look like. Here's the risks that we're exposed to, without getting too deeply involved with all the statistical underpinnings of duration and CAPM and all the rest of this, because those are very complex models. And the thing is, you don't want to have to be able to introduce statistical concepts to management when this is not what they do. They don't know, this is not their specialty. So it was the hope was that it would be easier to publish numbers that people could all point to and say, well, we understand what this means, and then make decisions based on that. In fact, even to this day, there are banks, and maybe it's all of them, I don't know, where they set the limits on their traders based on this value at risk number, because then they have a sense of how much risk the traders are allowed to take and how much money they could potentially lose overnight. So it's a way of keeping an eye on the traders and how much risk they're taking. But it also means that they can look at their own investment portfolios and get a sense of how much risk is in these portfolios. And so the ultimate advantage of all of this is that it suddenly became possible to create a single risk measure that it could incorporate every financial asset in the market. In other words, it didn't matter if your portfolio contained stocks or bonds or currencies or commodities. No matter what it is, the value risk framework provides a single number that we could use to represent the risk of the entire portfolio. Now, it isn't always easy. The one thing we have to point out here, though, is that in a portfolio with many different kinds of assets, the value risk framework can only give an approximate answer, because you're combining, essentially it's like apples and oranges. You're lumping them all together and coming up with a single number. And that's more of a problem for some types of assets than others. Now, another great thing about this is that we can easily determine the impact of hedging a portfolio with derivatives. Okay, now so you can actually sit there and say, listen, what would happen to our portfolio's risk if we buy a call or a put or whatever the case may be? Because of the way it's structured, it's not difficult at all to do that. So, and that's awfully important to be able to quickly and easily recalculate the risk of a portfolio by adding some derivatives to it and seeing what the impact is. Now, having said all that, for some securities, calculating value at risk can be extremely complex. Okay, but it can often be done with existing risk measures. So in other words, the value at risk of a bond can be computed or derived from its beta. So in other words, we still might need these existing risk measures to help us calculate the values of risk. So it's a very powerful framework. And once people started seeing it in action, it started to really catch on. And in fact, to this day, pretty much every financial institution has its own risk management group, and they always publish these value at risk numbers for all their holdings because everybody understands what these numbers represent. And even if you do not particularly care for the value at risk methodology, you at least you understand what it's telling us. Okay, there are people who think, there are ways we can improve it, and there's a lot of research, of course, always going on to see what we can do to improve its predictability, but also to streamline it a little to make it quicker, because it can get very cumbersome. So it's a really interesting area. Now, like models such as the Black-Scholes model, value at risk is based on several key assumptions, such as the idea that the returns to assets are normal. Now, we saw with Black-Scholes that's what Black-Scholes is doing, but it's not exactly right. The question is, how far off is this going to be? So we'll see pretty soon when we get to that point that this assumption, unfortunately, can lead value at risk to underestimate the true risk of an asset or a portfolio. Okay. Let me just give you oh, that's right. Damn it. I forgot I'll tell you what, I'll see what I can do with the maps. I'm not at my house right now. And so I unfortunately forgot my tablet. So I'll see what I can do with this maps. I know that's very difficult to draw with it. So let's just say here is your normal curve. And let's just say that that wasn't so bad. The real returns of these assets look more like this. There's another, oh, Jesus. There is a lot of area in the tails and not quite as much in the middle. Okay, I can live with that. So in other words, what are we looking at here? Oh. So the, I guess we'll call it red curve, represents actual returns, while the black curve is the normal distribution. With the red curve, there are more extreme outcomes, both gains and losses, than would occur with the normal distribution. Now, from the perspective of risk management, we're not really too concerned about the upside of this curve. We're really concerned about that left tail where the losses take place. So the left tail, as we call it, the actual returns, contains more area than the normal distribution, which means that the actual probability of large losses is greater than suggested by the normal distribution. Okay, so it's being a little not quite conservative enough, in the sense that it's telling you the likelihood of having a very large loss is lower than it really is. Now, there have been some interesting cases, which I guess we can briefly talk about them right now. But before we do that, let me save this document for the love of God. The longer the document is, the more likely the power is to go out. You know that. And therefore, you lose all your work. The only thing that you cannot recover with Word is the document still says book 1 or something like that. Anything else, it can hang on to it. All right, now it can continue. Okay, so the likelihood of being in that left tail is actually higher than suggested here. And so that means that using the normal distribution means we're actually understating the true risk of our portfolio. So anyway, so one of the derivatives disasters that took place in the late 90s. Now, this is something you'll find very interesting. You'll recall that the Black-Scholes model was actually developed by 3 people, Fisher Black, Myron Scholes, and Robert Merton. I think we looked them up last week just to see what's going on. Apparently, only Scholes is still alive. So now we know that the Black-Scholes model was published in 1973, and Fisher Black died about I'm trying to remember when he died. He died pretty young. He had cancer. So by the time the Nobel Prizes were handed out, he was gone. So Scholes and Merton shared the Nobel Prize in economics in 1997, when Fisher Black had already died. Okay, great. Now, you probably, if you ever look at the history of these Nobel Prizes in economics, you'll notice that they tend to be given out like way after the fact. This paper was published in 1973, and it took 24 years to get around to giving them their Nobel Prize. There's something about the economics prize, it tends to be more of a lifetime achievement award than anything else, not for a single great development. So it took a while to get to them. Now, here's the fun part. I shouldn't say fun, but interesting part. By this time, a few years before this, Scholes and Merton founded a hedge fund in the early 90s called Long-Term Capital Management. So you figure, all right, these guys are Nobel Prizes. People will flock to them. And that's exactly what did happen. I mean, all they had to do was announce that they were running a hedge fund, and everybody came out of the woodwork and said, here's money, please, invest it for us. Now, what we know about hedge funds is that they're unbelievably risky. They're a way for rich people to gamble, basically. And so a lot of these hedge funds will not accept clients unless they have a certain minimum amount of money in the bank to withstand losses, and they have a certain level of financial sophistication that they understand what they're really getting into. So what these guys were doing now, every hedge fund has its own unique set of strategies. Long-term capital management had several, of course, strategies, but what they were really doing was they would find opportunities that could make small amounts of money, but they would finance these opportunities with massive amounts of borrowing. Now, what was the point? Well, it means that if you have a tiny little profit opportunity, but let's say you've leveraged it 1,000 to 1 or something like that, then it could turn into a lot of real money. I guess it would be like buying a stock let's think about this. Imagine if you borrowed $1 million to buy Apple stock, and then the next day the price goes up by $1 and you sell all your shares, you repay your loan, and you still have some money left over. That's the kind of thing that they were doing. The problem with something like that, though, is that if it goes down $1, you could actually really, really get clobbered. I mean, really get clobbered. So these guys, they were of the opinion that if trouble started to develop, they could easily unwind their positions and minimize their losses. So they didn't have anything to worry about. And so they actually had a few good years in there. The first 3 or 4 years, they were really cleaning up. I seem to remember that the returns were something like 40% in the first 2 or 3 years, and then they had a return of 20. So along comes 1998. So in 1998, LTCM had positions in emerging markets debt. All right, now these are bonds issued by small countries. Emerging markets is essentially everything besides the major U.S., major Western powers, I guess we should call them. So, like Argentina, for example, could still be considered an emerging market. And so if you own bonds issued by the government of Argentina or, any other types of securities, this is emerging markets debt. Now, what they're effectively doing is they would take a short position. Now, let's think about this for a minute. If they expected, how would this work? Now, remember, these are bonds. Bonds rise in price when interest rates drop. So imagine the following scenario. Suppose that LTCM thinks that emerging markets yields would get closer, would fall to levels closer to the US Treasury market. Okay. So what that would mean is that emerging markets bonds would become more expensive relative to US Treasury bonds. Okay, so there's the yields in these emerging markets countries would start to fall and get a little bit closer to US levels. So that would make emerging markets bonds become more expensive relative to US bonds. So how could they benefit from this? The strategy would be to sell US treasuries short and use the proceeds buy emerging markets bonds. Okay. But the short sales are where the borrowing comes in. They're basically selling off these bonds that they don't own. So in other words, they have to buy them and then sell them and then promise to buy them back. Anyway, so what actually happened is that the Russian crisis of 1998 broke out, where the new Russian government announced that it would not pay or honor the debts of the Soviet Union on the grounds that it was a different country. And imagine them coming out and saying, listen, if you bought bonds from the Soviet Union, you're out of luck. We're not going to pay for them. It's not our problem. Okay. And of course, it was partially because they simply couldn't afford it. So this sent shockwaves throughout emerging markets countries as investors withdrew their funds from these countries, placing downward pressure on emerging markets bond prices. So in other words, they're on the wrong side of this. They're buying these bonds and all of a sudden the prices are collapsing. So unfortunately for them, wanted to sell their emerging markets bonds, but there were no buyers in the market. They could not unwind their positions. By the time the dust settled, they've actually lost like hundreds of billions of dollars. I mean, some unbelievably preposterous amount of money. It was just gone. So in order to prevent a collapse of the world's financial markets, the Fed arranged a bailout financed by the financial institutions who had lent money to LTCM. Okay, in other words, they were telling the banks, listen, you are partially responsible for this. Therefore, you're going to put up some money and help us bail this thing out. So, of course, LTCM closed its doors because they lost all this money. And they've caused quite a panic, as a matter of fact. But what was interesting is that afterwards, the principals stated that what had happened, according to their models, was so unlikely that it should not have happened even once in the entire history of the universe. In other words, it was according to the models that they were using, which included value risk models, that something like this should never have happened. Okay, it was so unlikely, like getting hit by lightning 100 times in a row, that kind of thing. So what this means then is that long-term capital management was either incredibly unlucky or else their models were seriously understating the true risk of their positions. I think we know which one we can sort of say right now happens to be the case. Of course, they weren't unlucky. Their positions were unbelievably risky, and they just weren't fully taking that into account. And then on top of that, since neither Merton nor Scholes were traders, they did not fully understand, apparently, how quickly liquidity can dry up in a market that is undergoing a panic. In other words, according to their models, anytime something started to go wrong, they could simply just unwind their positions and minimize the losses, but they didn't realize they could get stuck like this, where they're trying to sell bonds that nobody's willing to buy. So the ironic thing about all this is that in 1997, Merton and Scholes win the Nobel Prize in economics. And in just 1 year later, Merton and Scholes nearly destroyed the world's financial system. So that just shows you, well, sometimes you're up and sometimes you're down. Now, from what I understand, after all this was over, They went back and started up another hedge fund in Greenwich somewhere, but they kept a very low profile, or Stanford. It was one or the other. And they just kept it very quiet, but they're just having another hedge fund. It's like, what the heck? We didn't destroy the world's economy last time. Well, let's keep going. Well, anyway, but the point of all this is that having a model that depends on certain assumptions that are not true. The issue here is that we're in a position where we're basically, potentially at least, understating the true risk of our portfolios. And that, of course, is the opposite of what you want as a risk management group. If anything, you should be overstating the true risk. You want to have like the worst case scenario outlook. So, the assumptions of a model can be very, very important. And now there's other issues here too. So you probably figure, well, why don't we ditch this assumption? Well, the problem here is that, unfortunately, while it is possible to use other distributions, they are significantly more complicated. And the results so far have been extremely mixed, let's just say. In other words, it's nobody's ever been able to come out and say, listen, here's something we should do instead, because this always works better, or it usually works better. It's not the case that somebody's found a different approach that will definitely improve our risk management methods. And even if it does, you have to ask yourself, how much complexity are we willing to put up with to improve our results maybe just slightly? Also, there's a lot of thought that, according to the law of large numbers and the central limit theorem, if we have enough securities in our portfolio, their returns will be approximately normal anyway. It's not like this is a ridiculous assumption. It's just that it can get us into trouble in extreme cases. But the problem is it's those extreme cases that we're trying to guard against. So that's why it starts to become a problem. Okay, so there's the very times when we really need it the most is when it's likely to break down. I guess it's kind of like a car that's fine as long as the weather isn't too cold. That's not exactly what you want. But anyway, so this was meant to be an introduction to this field. But we'll see when we get to that point that we can use the Greeks to easily calculate the impact of an option on our portfolio's value at risk. So to a certain degree, this topic ties together a lot of the concepts that we've been looking at. So anyway, so the good thing about value at risk is it provides us with a framework that makes it possible to directly compare the risks of many different types of assets. It doesn't matter what they are, stocks, bonds, currencies, commodities. As long as they're trading in the marketplace, you'll have no trouble combining them into a single portfolio. It could be time consuming, but it is doable. All right. By the way, this is, this is the kind of thing where you don't sit down with a calculator and do this stuff. This is reserved for gigantic computers that are running all night long to come up with these numbers, because if you own thousands of assets, let's say you're a major commercial bank, this is going to take a very long period of time. And also, one of the problems with a framework like this is that it requires an awful lot of data, a lot of consistent data that's available across the board for possibly several years. And sometimes the data just isn't there. Like certain types of options don't trade on a regular basis. And so there'll be gaps in your data, and decisions have to be made about what to do about missing data and how to fill it in, and how that affects our other results. So there's all kinds of potential complications here, but still, the framework itself is surprisingly simple. So we already know, as I've discussed, the risk of a stock or a portfolio can be measured with beta from the CAPM model, which, interestingly enough, the developers of the CAPM also won the Nobel Prize in economics. And the risk of the bond or portfolio bonds can be measured with duration. Okay. So for all this time before value risk came into being, we couldn't directly compare these risk measures, But now suddenly we have a consistent framework, which means we can throw them all together into the same portfolio and come up with a number that makes it possible to compare one portfolio's risk with another. So this is an incredibly simple example of this. Imagine you own $100 million worth of IBM stock, and that's it. And we discovered from historical experience that the stock, once every 20 trading days, or 5% of the time, the potential exists for the losses in the portfolio to go beyond $20 million. Or in other words, the value of the portfolio could potentially dip below $80 million 5% of the time. Now, you notice that there's no mention of what the upside is. And again, because this is risk management, we're really not that concerned with it. What we're looking for is the downside. This is what we're trying to guard against. And if, by the way, if the downside is uncomfortably low, that is a signal that it's time to either sell off some of the risky assets or possibly do some hedging with derivative securities. Okay, so this would be one way you know how much you should really be hedging. Because we can't completely eliminate all risk, of course not. And even if we could, we would end up with just earning the risk-free rate of return. So that's not exactly what we're aiming for. What we're really trying to do is leave ourselves not quite so vulnerable to risk. You know, it's like car insurance. Sure, it covers any accidents you might have, but there's still a deductible. So you still have an incentive to avoid crashing your car. But at least you know that if you do crash it, you won't be suffering any catastrophic losses. Your losses will be relatively minimal. Okay, so we're going to think of this as the VAR, the daily VAR. By the way, this is per day. Okay, we have to think of the time frame of value risk. So we're going to claim that the daily VAR of this portfolio is $20 million. And because this can only happen once every 20 days, we can call this either a 95% level of confidence or a daily 5% VAR. Okay, in other words, the losses should not exceed this level more than once out of every 20 days. Now, if you're thinking in terms of the normal distribution, let's do a little graph here. Actually, I'm kind of surprised this graph turned out as well as it did. I'm going to steal it for the next illustration. Okay, so in other words, assuming that your portfolio follows the normal distribution, which you may be familiar with. I don't know how much statistics everyone has, but this curve represents the normal distribution. It's centered here. And the entire area under this curve is 1 or 100%. So 5% would be, let's say, here. This is where you would have your lowest 5%, worst 5% outcomes, let's say. So if the portfolio is currently worth $100 million, and 5% of the time that could dip below 80, that represents 80 and below is the left 5% tail of this distribution. So the value of risk is actually this distance right here. How far could it go down if things go wrong? Okay, so that's not too terrible, I guess. So the question is, how do we find this point? Where did that come from? All right, then. And by the way, this curve could represent any number of assets. The entire portfolio's returns are being illustrated by this curve. You can see there's a center. The most likely outcome is to stay at 100 million. There's a 5% chance we could fall below 80, but because of the symmetry of the distribution, there's also a 5% chance we could go above 120 million on the right side. But the value risk methodology, like I said, is only focused on the lower side of this distribution where the losses are. Now, most of the time, it's going to be a lot more complicated than this, of course. So yeah, here's an illustration I did with the actual tablet. You can see it's a little cleaner. Now, in order to actually implement the value risk methodology, we do need to use the normal distribution, which Excel, of course, has that in there. We just have to see how to use it. Which reminds me, we do have several wonderful spreadsheets here that we can use. We don't want that. But unfortunately, like I said, you'll have to go find them in your inbox because the Brightspace is useless. Now you can use this to review the normal distribution if you really want to. I don't think it's absolutely necessary. Maybe we'll come back to this when we need it. But I just want to point out that for the value risk methodology, we're going to use a special case of the normal distribution. Let's just quickly mention a few details here. The normal distribution is uniquely characterized by its mean and standard deviation. Okay, the mean determines its location on the real number line. I'll draw a picture of this in a second. And the standard deviation refers to how spread out it is. Okay, so let me try to draw a couple of these for you. All right, why is it acting like this? So imagine there's two different normal distributions that have the same standard deviation, but a different mean. So this one, for example, let's say it has a mean. Oh, you know what I forgot to do? I forgot to introduce some terminology or notation here. The mean is usually represented with the Greek letter that should be here. I use it all the time. Here it is. Fancy U is mu, that's the mean, and the standard deviation is represented with the Greek letter sigma. All right, just so that when you see it on the graph, you'll know what we're talking about here. Okay, so let's just say that here the mean is 0, and here it's 5. But the standard deviation is the same in both cases. Let's say it's 10. Now, that's pretty high. Let's call it 1. So basically what this is showing you is that the two curves have a different location, but the same spread. Their shape is exactly the same. If these are two stocks, for example, they have the same risk. They have the same risk. In other words, the standard deviation. But the first stock has a mean return of 0, and the second stock has a mean return of 5%, let's say. So if they have the same mean but different, the same standard deviation but two different means, they'll have the same shapes but different locations. Now we're going to see the opposite case where they have the same mean but two different standard deviations. Okay, so they both have a mean of 0. The one that's really spread out has a standard deviation of, let's say, 5. And this one, it's 1, just to make it simple. Okay, so the two distributions have the same mean of 0, but the distribution with the standard deviation of 5 is more spread out and is spread out. If these are stocks, then the second stock is riskier because it has a higher standard deviation. Okay, now for the family risk methodology, we use the so-called standard normal distribution, which it matters a great deal when we go to Excel, where the mean is 0 and the standard deviation is 1. Okay, so just keep that in mind when we're using this formula. So the interesting thing about the standard normal is that it's easy to identify what each of these values represents. So in other words, let's try this. Oh, by the way, one more thing. The standard normal distribution is usually designated, just so we know what it is when we see it. So the results, the numbers that we'll be seeing are sometimes called z-scores. You may have heard of that term before, z-scores. They represent locations under the standard normal curve. So let's say, for example, if something like this, the center, the mean is just 0. A 1 in this distribution means the mean plus 1 standard deviation. -1, which actually that's a terrible drawing. They're supposed to be the same distance on either side of the mean. -1 would be mu minus sigma. So over here, +2 could be interpreted as mu plus 2 standard deviations. And over here, it's mu minus 2 standard deviations. So there's the great thing about this distribution is the numbers, the z-scores, these are the z-scores, by the way, these numbers down here correspond to different numbers of standard deviations above and below the mean. Okay. Now we can use Excel to find out what is the probability of reaching any of these values. So just as a quick example of how this would work, suppose, for example, that on an exam, the mean score is 80 and the standard deviation is 5. A student earns a score of 90. This equals 2 standard deviations above the mean. And there's 80 plus 2 times 5. What is the probability of achieving a 90 on this exam? This is equivalent to saying, what is the probability that z is less than or equal to 2? So in other words, actually, I shouldn't write it that way. More than a 90 in this exam is what we're actually looking for. So we're looking for a greater than 2. So greater than 90 the score could be represented by X, is the same thing as saying, what is the likelihood that the z-score were above 2? Okay, so this is where Excel comes in handy. So we go to Excel, and let me start a new sheet here. What is the probability getting a grade above 90? This is equivalent to, getting a z-score above 2. So here's how it works with Excel. The function you need is called norm s.dis. Now, in order to use this, what you need to do is 2 things. Z is 2. Cumulative, always put a 1 here for cumulative. That means less than or equal to. So now here's the thing, though, we have to watch out for. This is actually the probability that Z is below, less than or equal to 2. The probability of getting above 2 equals 1 minus that. So what you would have is equals 1 minus this number. And so there's only basically a 2.275% chance of getting above a 90 in this test. Okay, so in other words, if you drew a picture here, it's way up here. The piece you're actually looking for is this 0.02275. All of this is 0.99 or 97725. Okay, so that would be a typical example that you might run into with the standard normal distribution. So the value risk formula does include this or use this. Okay, so this way, when we get to it, It'll be easier for you to figure out what it's talking about. Okay, so let's carry on. Now, value risk can be applied to every asset in the economy, but for some, it's easier than others. In other words, for an option, calculating value risk is very complicated because, as you can see from these graphs, an option is what we call a nonlinear asset, meaning that the relationship between the stock price and the option is not linear. It's not a straight line. The one on the right over here is actually the relationship between the stock price and a forward contract written on it. So for a forward contract, the relationship between the stock and the forward, or any price, any asset for that matter, is linear. It's a straight line. So there's, for any given change in S, the impact on the forward contract is always the same. Not so with the option. Depending whether the option is in, at, or out of the money, the same change in S could have a very different impact on the call price. And in fact, we already saw that last week when we saw that the delta goes from very low in this territory down here, where it's out of the money, and the delta continues to rise until it almost reaches 1. So that means it's a nonlinear relationship. And in fact, as you know, anytime before maturity, this is what it looks like. And that is definitely not a straight line. The value at risk methodology is based on, or easily suited for linear assets. It's much more involved for the nonlinear ones. We have to make a lot of interesting adjustments to take that into account. Now, one of the things, so this can make it much more complicated than it looks. And also, one of the problems we have with VAR is that let's call this 2 different problems with VAR. Number one, it can be very complex for nonlinear assets. Okay. Such as options being the classic case of that. And number 2, the other issue that they raise here is that it only shows us the left tail of the distribution. Or actually, what I should say is not even the left tail, the threshold. Okay. In other words, the cutoff point between the, let's say, the lower 5% and the rest. This $80 million is our threshold. All it's telling us is how far do we have to go to reach that point. What it does not tell us is what might happen to you if you do reach that left tail. It's not telling us how much you could potentially lose if you get deeper into that tail. It's just telling you where is the tail located. Okay, that's the cutoff point between the left tail and the rest of the distribution. And that means that we're losing a lot of useful information in that left tail. In other words, what we're worried about is it does not show the potential magnitude of losses in the left tail. Now, luckily for us, fortunately, this second problem can be avoided by calculating a supplementary measure known as expected shortfall, which is essentially the average VAR in the left tail. So that seems to work pretty well. All right, this expected shortfall was dreamed up later on when people say, well, we want to really know what's going on in that left tail. And so that's how they got around this problem. But, it's going to be a very complex thing to do with options and other non-linear assets. All right. So what assumptions are we making? Well, we've already seen the big one, the normal distribution. There's a couple of other potential issues here. Number one, returns to assets are normal. Number two, returns to assets over time are independent of each other. Okay, now that would indicate that, and it seems like a bit of a stretch, this would mean that an event on Monday that impacts a stock's price would be completely, I guess I shouldn't say irrelevant, would not continue to affect the stock on Tuesday. It's like we're starting all over again, basically. But like, imagine if on Monday, Apple says, you know what, we have to lay people off. We're supposed to believe that on Tuesday, this is old news and nobody's paying attention to it anymore. Well, that seems a bit strange. But the advantage of this assumption is that we don't need to take into account the correlations between the returns at different points in time. Because if we did, that would take forever. It would be such a mess. Like just even for 30 days, you'd have correlations between day 1 and 2, day 2 and 3, 3 and 4, 2 and 1, every possible combination, and it would just be a nightmare. So the assumption here is being made to basically streamline the whole thing and speed it up a bit, even if it means introducing some unrealistic behavior here. And we're assuming that the statistical properties of the assets in a portfolio remain constant over time. Their means and standard deviations do not change. Now, we know that this is probably not true, especially if we have a long enough time frame, or a reasonably long time frame. The standard deviations, i.e. volatilities, they're called, are unlikely to remain constant. Although if you recall, that's one of the assumptions made by Black-Scholes. And that's really one of the reasons why they kept it for this one. But and the means can fluctuate too. But it's the volatilities that are the big problem. Okay, so that means if they do change, we're not capturing that with our value at risk model. Okay, especially that when times are tough in the markets, volatilities tend to spike up, as we've already seen. Now, here's one of the nice things about one of the consequences of these assumptions is that the standard deviation or volatility of an asset can be easily extended to other timeframes. Okay, in other words, a daily volatility can be easily converted into, let's say, a monthly volatility with the so-called square root of time rule. And how does that work? Well, let's see. So let's look at this formula for a second. All right, give this thing a minute. Oh, God. So what it's saying is that, for example, suppose that there are 22 trading days in a month. If a stock's monthly volatility, or sorry, daily volatility is, let's say, oh, I don't know, 1%. Now, here's where it gets interesting. The monthly volatility would be 1% times the square root of 22. Not 22, but the square root of 22. All right, let me get out the old calculator here. About 0.0469%. Okay, so in other words, you can scale the volatility up and down as you see fit. If you have daily data in your for whatever data you've obtained, and you're only interested in calculating value risk over a single month, not a problem. You can take your daily vol of 1% and turn it very quickly and easily into a monthly vol of 4.69%. But you have to take into account two things. Number one, you're using trading days rather than actual days. And also the standard deviation increases with the square root of time, not time itself. Notice it doesn't double. If the time frame doubles, it doesn't double the volatility. It increases it by a factor of the square root of 2. Now, this wouldn't be possible without our assumptions. Doing this would actually be much, much, much messier. So, in a lot of ways, it's like the CAPM model. A lot of it is based on fairly unrealistic assumptions, but as long as it works, that's the important detail. In fact, there's a great economist who's no longer around, but he had this great quote about models and realism. Let me see if we can find it. I want to find his quote. Oh, no, not that one. No, I can't seem to find it. He had a great quote where he basically said what matters to a model is not the realism of its assumptions, but the validity of its predictions. In other words, if you have a model that works well, even with crazy assumptions, it's still a good model. Okay. If you're forecasting the Dow Jones by using a Ouija board, for example, well, if it works, keep using it, even though it's pretty ridiculous. But so he's basically saying that a model can be useful if it works, in spite of its unrealistic assumptions. And so that's what's happening here. We know that these assumptions are not necessarily true, but by making these assumptions, we can really streamline our calculations quite a bit. And that's really important with value at risk because it can get unbelievably time consuming if we have a fairly large number of assets in our portfolio. So this is an important, assumption. So here's the drawbacks to these assumptions. And as I've already mentioned, the tails of the distribution of returns is actually a little bit wider or more spread out than we would generally assume. So we're understating the likelihood of those large losses with the red curve, as we've already discussed. So we're understating, like in a way, like Myron Scholes and Robert Merton did with long-term capital management. They did not understand how something like this could happen, or at least how likely it was. And, they almost destroyed the world's economy. Now, another way in which the returns are not really normal is that there tends to be a bit of a bias towards losses. So if you look at this red curve, you can see that it's sort of skewed to the left in the sense that the average return in the red curve is below the black curve. So in other words, the actual returns, because there's sort of a bias in favor of the losses, are likely to be lower than they would if we had the normal distribution. So you find yourself essentially overstating the true returns to your portfolio with this model, which is not the best thing in the world, because you were hoping to properly capture the risk and return here. Okay. And of course, the statistical properties don't really stay fixed, especially the volatility. And, we've looked at the VIX before, and we saw that the volatilities can change quite a bit in the economy. So we don't need to go through that again. Now, with all that being said, let's calculate the value risk. Now, it's a surprisingly simple formula. So let's see. Let's copy this into this document for a second. Now, you look at this and say, no, there's no way it could be that simple. Well, this thing, V0, is the initial dollar value of the portfolio. And of course, the sigma is the volatility. What in the world is this thing? This is the tricky part. Although, as we'll see, we tend to use the same numbers most of the time. This is the inverse of the standard normal distribution. So in other words, here's what we're all about here. Here's our standard normal. And imagine we are looking for the left 5% tail of this distribution. So the question is, how far below the mean are we here in terms of standard deviations? Well, for this particular case, and we'll look it up in Excel later on, but it turns out that this is, oh, jeez, 1.645 standard deviations below the mean. Okay. Now, so we need that number, that 1.645 for the formula. This symbol here actually stands for the 1.645. So you replace this thing with 1.645. It's basically saying, where are you located under the curve for the left 5% tail? 1.645 standard deviations below the mean. Now, in Excel, what you would say to it is, listen, I don't know where this is. How did we get that? The function you need there, let's see. How would we do this? So in order to identify that 1.645, what you would actually do is use the Excel function. So let me type this in here. So we're going to use the, what's going on? We're going to use the function norm dot s dot inv. And you notice how it says the word probability. What does it mean by that? 0.05. So, oh. You're saying, where is the location below which we find 1.645, 5% rather, of the distribution? So that's how Excel takes care of this. So we're going to need that in our value risk formula. Anytime we want to calculate VAR at the 5% level, we're going to need this negative 1.645 term, because it shows us how far we have to go from the mean in order to reach this tail. All right. And by the way, there are other, what if you wanted a different tail, which is sometimes the case? What if you're only interested in the bottom 10%? Oh, actually, sorry, that should be further to the left or to the right. So that this entire tail area is 10%. All right, let's find out. To find the threshold for the lower 10%, you would change this to 0.10. And so I'm going to change that to 0.10. And it turns out to be about negative 1.282. Let's put that here. And so in principle, we can look for any left tail we want, but in practice, value at risk is calculated for the left 1%, 5%, or 10% tail. The others are kind of unusual. These are the normal ones. And the one that you pick depends on how conservative you want to be. The more conservative a financial institution is, the smaller will be the left tail it uses in its calculations. All right. So then we have all three terms here, and we can now calculate anything we want. So it's a lot scarier than it looks. I mean, it's less scary than it looks. So let's say, for example, let's try this one. An investor owns $10,000 worth of Hewlett Packard stock. We've determined from going into Excel and getting daily stock prices for Hewlett Packard that the volatility rather, is 1.89% per day. Therefore, the 5% VAR is this. Now, by the way, I almost forgot to mention, we have this negative here because we know that this number taken from the normal distribution is going to be negative, given that it's in the left tail. We don't want a negative number. It's awkward to deal with. So we're just essentially getting rid of the negative there so that we understand that this is actually a negative number. But if you multiply all three together, the $10,000 value of the portfolio, the 1.645 standard deviations below the mean, and the daily vol of 1.89, their daily VAR is about $310.90.5. That means on an average day, potentially we could lose $310.90.5 or more. Okay, so that's the cutoff between the left 5% tail and the rest. All right, now, if the upper level management thinks that's too much, then they might ask to sell the stock or buy a different one, or maybe do a hedge of some kind. Okay, that's our first. Now, what happens though if they're not interested in the daily VAR, but the monthly VAR? What they're going to do is take the same exact numbers and make one little change. Let me just copy this. And that involves the square root of time rule. Because remember, now we're dealing with a month, which we're assuming has 22 trading days. So we're going to multiply the volatility by the square root of 22, because that number that we're going to get is now the monthly standard deviation. Whatever that number is, it's multiplied by the same first two numbers. And so over a month, we're looking at 1458.27. So it's going up by about 4.5 times. Okay, notice how it didn't go up by a factor of 22. Okay, instead it only went up by about 4 point something. And then, if we want to turn this into a daily VAR, we need to replace, we're assuming that there's 252 trading days in the year. Now, every book handles this a little differently. Some books assume there's 250 days in a year, trading days, that is. Some use 252, some use 255, some use 260. We're going to stick with 252. I believe Hull didn't write this, but he has another book out there in the market where he does mention some of this stuff. And I think he likes to use 252 as well. So in other words, it depends on what time frame we're interested in. Okay, so now it turns out that sometimes calculating VAR as a dollar amount is not the best idea in the world, because you can imagine why. Imagine we have a bunch of different portfolios. Let's say this is some kind of a trading firm, and they have all kinds of traders working on different portfolios. And some of them have, $1 million portfolios, some of them only have 100,000. The VARs of $1 million portfolio and a $100,000 portfolio will, of course, be very different just because they're of different sizes. So in order to compare them on an equal footing, apples to apples, what we do sometimes is actually just use not the dollar amount, but the percentage amount. So we call this percentage VAR. What we were just doing is called dollar VAR. Now we may want to use percentage VAR. And if you notice, all that's happened is that we have gotten rid of the V. Remember back here? Yes, so this is how we calculate the dollar VAR. Okay, so now all we're doing is leaving out the portfolio value. And we end up with a percentage VAR. So now we really can directly compare these side by side for any different portfolios that we choose, or individual assets for that matter. Okay, so now up to this point, what we've been doing is calculating the VAR for a single asset. Usually that's not what's going to happen. I mean, the examples we've done at least involved a single asset. What if we have a whole portfolio of something that we want to calculate its VAR for? Well, then things get a little complicated, because we have to consider the correlations between the assets in the portfolio. Now, we're hoping that the correlations are low. The lower, the better. Now, if you recall, just quickly, just want to mention correlation. The way this correlation coefficient is defined is bounded between -1 and +1. -1 means that two variables are perfectly negatively correlated. They always move in opposite directions. Okay, +1 means that the two variables are perfectly positively correlated. They always move in the same direction. Okay. A correlation of 0 means that two variables are completely unrelated to each other. They're then referred to, or said to be, independent. So correlation is a measure, a statistical measure, which has to come out between negative and +1. If it's -1, the two variables are going in opposite directions all the time. +1 means that they're always going in the same direction. And 0 means they are not related to each other at all. So it turns out that the lower is the correlation coefficient between assets in a portfolio, the lower will be the risk, and therefore the lower will be the value at risk. So you're hoping that these are very low. It's not always possible to find negative correlations, but if you're choosing stocks, for example, stocks from the same economy, there's going to be some correlation no matter what you do, because they're all related to the same business cycle. In fact, I saw a study somewhere that the average correlation between two US stocks is about 0.33, which is a fairly strong, not that strong, but a reasonably strong positive correlation. So as far as picking stocks for your portfolio, if you want to minimize your risk, you want a very low level of correlation. By the way, I just want to show you a special type of graph that illustrates this very nicely. Imagine you take the returns to two stocks and just plot them. And what we're going to do is draw a line through here that tries to get as close as possible to these points. Each point represents the returns to stock X and Y during a different year. All right, it's hard to draw this with the mouse. So what this is telling me is that the correlation, which we'll designate with the Greek letter rho, is positive. Okay, there's a tendency for both of them to either rise or fall at the same time. So this rho is the correlation coefficient. Okay, I guess I have to line it up better than that. Okay, now let's say we have two stocks who do the opposite. They tend to go in opposite directions because they're in very different industries. So you're going to get something like this. And that means the correlation is negative. Because they're going in opposite directions. And then down here, now this is a little tricky to draw, but I'll try it. What you're trying to do is show that there's essentially no connection between the two variables at all. In other words, there's no pattern here. They sometimes both go up, they sometimes both go down, sometimes they go in opposite directions. There's absolutely no rhyme or reason to this. And okay, well, that's not the best drawing, but that's what it would look like. The curve, this line would be flat, and this is 0. So that really covers the three basic cases: positive correlation, negative correlation, and no correlation. We have to consider this when we calculate the value of risk for any portfolio that has at least two assets in it. Ideally, we want the correlations to be negative because that means that the risks are offsetting each other to a certain degree. Negative or very small and positive, since this means the risks to the assets are offsetting each other to a degree. That's what you're aiming for. If you don't have that, well, you don't have it, but that would help reduce the risk more than anything else. So anyway, another thing we have to take into account with the portfolio value risk is how much is invested in each stock or each asset, which we call weights. Okay, so in other words, we need to know, first of all, the correlations between the assets. And secondly, we need to know how much of our money is invested in each of these stocks or assets. And these are referred to as weights or proportions of the total invested. Of course, we need to know each stock's individual volatilities, and we need to know the correlations. We don't need the expected returns, though. This is the portfolio risk. The portfolio expected return is very straightforward. But anyway, let's look at this formula for a second. This is the volatility or standard deviation of a two-asset portfolio. Okay. So you notice how we're using the standard deviations, but that little p here indicates this is the portfolio volatility or risk. This is what we'll need for a value risk formula. So when it's a portfolio, I'll just mention that now. Everything's the same except for one little detail. The first two are identical. What's changing is now, instead of sigma, it's sigma p, to remind us that this is the volatility of the entire portfolio. And that's going to be fairly complicated, as you can see. We need the two weights. Here we have stocks X and Y. We have the weights, we have the volatilities, and we have the correlation coefficient. You can see why this row should be as low as possible, because the smaller it is, the smaller will be this entire expression. Okay. So we're going to do a quick numerical example of this. Okay. So using this formula with the following data, we have a $100,000 portfolio. 60,000 is invested in stock X and the rest in stock Y. We want to find the 5% VAR of this portfolio on a daily basis. Then we're going to extend it to monthly and yearly. Now, I've already done this for you. These are the standard deviations and the correlation coefficients. And just so you can see how this works. By the way, you know what I forgot to mention? There's no assignments this week. We're done. I'm going to take all of your 6 assignments and go through them this weekend and send you the answers, and so you know how you did. But we're done with assignments. We just want to learn more material tonight. Okay, so we plug these in, and you can try this in Excel. In fact, I'm not sure if the Excel spreadsheet I have here actually has this example in it. No, that's not the right one. There it is. The one that actually says value risk example, it'll be here. Yeah, there it is. Oh, but this one is very complicated. We've got, see, because here we're actually doing the calculations ourselves. Notice how we're only really interested in the returns of these stocks, not their prices. So what we had to do here is take the stock prices and the dividends and turn them into what are called holding period returns. And it's these numbers that will determine expected return of this stock, as well as the variance in the standard deviation, using Excel's built-in functionality. So we'll have separate measures for stocks V and Q. And we use Excel's formula to figure out the covariance, but what we really are interested in is the correlation coefficient, 0.0375. It's a very small number, which means that we'll get a significant amount of risk reduction. And then when you put these all together, two stocks, we're assuming 50% is in each stock. And then we calculate the expected return, the variance, and the standard deviation. And that is the final result right there. The portfolio standard deviation is approximately 0.0355. Now, that's kind of interesting because if you notice, it's only slightly higher than stock V, but it's a lot less than stock Q. So by having a low correlation here, we did achieve a significant amount of risk reduction. And the return to the entire portfolio is halfway between these two. So we're not giving up any returns, and yet by holding the right stocks in our portfolio, the standard deviation of the whole portfolio is much closer to the safer stock than the riskier stock. So that's one of the reasons why this is so important, because you can diversify your risks very nicely this way and still have a very high rate of return. And then down here, if you notice, we've got $1 million for the portfolio. This number is sometimes called a quantile. That's how far below the mean we are under the standard normal curve. The standard deviation is here. The product of those three is this number right there. We'll come back to this and look at it more closely in a bit. So in other words, yeah, but here this was extra work because we did have to calculate the returns ourselves and then come up with these measures using Excel's functionality. For example, this is done with the function average. This is done with the function var.s. S means sample, by the way, to distinguish it from the population from which this is drawn. And then standard deviation can be done by either taking the square root of the variance, or Excel's function is called stdev.s. And of course, we'll do the same thing over here for stock Q. And then the covariance has its own function in Excel. It's called covariance.s. And then finally, correlation is in Excel. It's simply, God, why is it doing this? There it is. Correl. Now, interestingly enough, with the correlation coefficient, we don't need to distinguish between a sample and a population because it would be the same in either case anyway. All the other measures, we have to specify that it's a sample. Right. Now, down here, there's some more tweaks to all this, but that's the basic logic behind the value risk framework for a portfolio as opposed to a single stock. Now, in this case, if you want to, you could try this in Excel too if you want, but we ended up with 1.05072 for our standard deviation, which, if you notice, is lower than for either individual stock. Okay, 1.05 as opposed to these two, because this time the correlation was actually negative. Okay, so by having negative correlations, the risk is reduced so much that the portfolio is actually safer than either stock by itself. And that's pretty interesting. Now, with all that being said, all the work, if you notice, is going into that standard deviation. The rest is easy. We've got the value of the portfolio of 100,000. We have the so-called quantile or Z-score, 1.645. Here's our standard deviation. So the daily VAR is about $1,728. To convert that to monthly, we multiply that by the square root of 22, which is about $8,100. And then to make it a yearly VAR, we multiply the daily by the square root of 252, and that's about $27,000. Now, if you really are interested in the dollar-only VAR, not so much the percentage, there's another alternative way of doing this. Which one you use depends on, which one you like better. But if you were to calculate the dollar VAR of both stocks individually, you could plug them into this formula and you'll end up with the same result. So let me show you how that was done. Okay, so notice, I don't know which one, I don't know if either one is necessarily quicker. It's just kind of interesting that you can do this. So like here, what I did was I showed you that the first stock has a daily VAR of about 1607. And by itself, just the first stock only. You see there's a standard deviation of X. And then for Y, about 1012. And this is the standard deviation of Y. And then when you plug all these in, you're going to get the same thing that we got, 1728.43. So that on a daily basis, I mean. So I don't know exactly when this would be quicker. I don't know, people might just prefer it because they think it makes more sense, but the correlation would be the same in either case. Okay. But either way, this is the 2-asset portfolio. Now, here's an interesting result. If you go back and revisit these two and calculate the individual VARs, well, actually, okay, so this is where this thing pays for itself. I forgot. If you calculate the individual VARs and add them up, the total would be 2619.23. But if you noticed, the actual VAR was 1728. So what's happening here is that this number is what you would get if the correlation between your two stocks was 1. Now, that's a significant number. If the correlation is 1 between two stocks or two assets, let me throw that in here. If two stocks have a correlation of 1, then there is no risk reduction from holding the stocks in a portfolio. In other words, for all practical purposes, they might as well be the same stock. Okay. It's like if you had Texaco and Texaco, then you're going to end up with a total VAR of the sum of the two stocks. So 1 means no diversification at all. So the undiversified VAR of a portfolio equals the sum of the VARs of the individual assets. This is the same VAR that would be obtained if the correlations between all assets are 1. Okay, now the VAR, diversified VAR, is the actual VAR of the portfolio. Okay. Now, in the example we had here, for example, let's say here we saw that the sums of these two. Well, let me just copy this. Okay, so that would be the undiversified VAR. But remember, the actual VAR in this case was 1728. .43. The actual or diversified VAR is much less than the undiversified VAR because the correlation between the stocks is negative 0.19. So the difference between diversified, undiversified is known as the benefits of diversification. So which would be in this case 2619.23 minus 1728.43, which is 890.80. So what this is saying is that by combining assets in this portfolio with a negative correlation, risk reduction is 890.80. So we congratulate ourselves for doing this, because if we just simply bought two positively correlated stocks, it would have been much higher. So, what this enables us to do is plan, what stocks might we buy for our portfolio. We should be able to calculate the impact of these new stocks on our portfolio. In fact, there are measures. Let's see if they're in here. What's coming up next here is we're going to see how options get involved with this. But what we're going to do, and we're going to look at this expected shortfall measure. There are measures that have been designed to determine how much the VaR of a portfolio will change due to the addition of a new asset or the sale of an existing asset, so that the entire portfolio VaR doesn't have to be recalculated. And you can see this would come in handy with planning purposes. Okay, so there's all kinds of wonderful advantages here. The upside is that you're getting a significant amount of risk reduction without losing any returns. In other words, the returns to two stocks are always going to be the weighted average of the two individual stocks. But if they have negative correlations, the risk of this combined portfolio could actually be less than the risk of either stock by itself. So the point of it is that you're getting a substantial amount of risk reduction without giving up any expected return. And so that's a huge deal. In fact, that's kind of like the whole point of having a portfolio in the first place, that you're reducing your risks without giving up any returns. Yeah, that's the whole idea. In fact, that's the heart and soul of modern portfolio theory. Well, because the return just depends on the returns of the individual stocks and their weights. That's all it depends on. It doesn't depend on anything else. So if I have, suppose, for example, I can choose between stocks A, B, and C. All right. All right, so let's say we have stock A. And so we have 10% return. The risk is the standard deviation, by the way. Actually, I'll make a separate chart for these correlations. And then we have stock B. And then we have stock C. And then we find out that the correlations A and B have a correlation of 0.50, A and C negative 0.20, B and C 0. So if you were to, I'll do this in Excel, it'll be infinitely faster. Let's just quickly throw this in here. Um, 10, 15, and 12. Risks are 20, 30, and 25. And let's say the correlations are between A and B is 0.5, A and C is negative 0.2. And the correlation between B and C is 3. All right, so we're going to create some portfolios. Let's say here's stock A and B, A and C. Actually, I'll tell you, let me label this a little differently. Just so you know what the weights are. So I'm keeping things simple by assuming 50% in each. And so all right, so those are the returns we get. Now the risks are going to be a bit of a mess. Um, oh, I need one more parenthesis. So for that portfolio, it's about 21.80, let's say 79%. Now for this one, oh, I think I may have done something wrong here. All right, let me do that again just to make sure. All right, those are fine. Yeah, I knew it's something. No, this is supposed to be D. All right, that's better. So it's 0.5 squared times E plus 0.5 times D plus 2 half C6 times B3 times C3. All right, good. And now for this one, it's B and C. The hell is going on with this thing? Now all of a sudden the delete key is not working. I'm getting so fed up with technology, I'm telling you. Oh, Jesus Christ. I don't know what's going on. It's refusing to let me type properly in that cell. It's just unbelievable. But up here, if you notice, it does seem to have the formula, but it's got this crap instead of unbelievable. Unbelievable. So you've got, all right, let's try that again. What the hell is going on? No. Something's horribly wrong with this damn thing. Yes, go ahead.
Yeah, hi. Without going into all the formulas, because I don't want to waste too much time here. What I was really wondering is that if you're going to invest money in stocks that are moving in the opposite direction, I guess, of the ones that you're really counting on, how does that increase your return if you're putting more money into a portfolio, but it's like going in a different direction than the ones that you're betting on?
Well, you're basically saying I want the two risks to exactly offset each other, or to the extent that's possible. So I'm looking for stocks, let's say, that are in very different industries, so that, let's say, in one case, oil prices go up and the stock benefits, and in another case, oil prices go up and the stock does not benefit. So it goes the opposite direction. You're trying to make sure that at all times you're doing the opposite, so that when one has a bad year, the other will offset it with a good year, and vice versa. All right, so I think I got
Yeah,
it.
that part I definitely understand. I understand like you want to reduce as much risk as possible. I was just wondering though, if they're moving in opposite directions, how does that increase your return?
Oh, it doesn't, but the point of it is that it doesn't decrease it. You're getting the same return that you would get with another stock with the same, everything's the same, but there's more risk. So in other words, you're saying, like here, for example, I've got A and B and A and C. In the case of A and C, I'm only getting 11%, but my risk is 3% versus 21.79%. And that's being driven by this negative 0.2 versus this 0.5. So I'm getting a little less return, but the risk reduction is quite dramatic. Okay.
Oh, okay. I see what you're saying. It's like a trade-off. I must have misunderstood you. I thought you said that you're getting a lot less risk, but the same return. Maybe you meant you're just getting a little bit less return, but you're still getting positive results. Is
Right.
that
It
what you're
depends,
saying?
right. It depends on what assets you've chosen, of course. But what it means is that you can reduce your risk quite a bit without significantly reducing your return.
Okay. All right. That makes more sense. I think I understand it now.
Okay. All right, let me see if it'll allow me to finish this properly. I don't know what was going on with the other one, and I don't even want to know. I'm getting really tired to death of all the nonsense with technology that I just can't seem to escape. It's just beyond belief to me how terrible this stuff really is. But anyway, just suddenly stops working. All right. So then you can see, now look at this one. That's a really sweet deal. The risk is higher than for C or this one, but you also get a higher return. So the idea here is that the lower this number, the lower will be the risk, but it'll have no impact on the return here. Okay, so like if let's say for some reason the correlation drops for some reason, you'll get a more risk reduction without any loss in return. But here, I think this speaks for itself right here. The fact that you can sacrifice 1.5% of return to reduce your risk by a factor of 7. Okay. So anyway, this is really what portfolio theory is all about, by the way. This notion, this is what we mean by diversification. And this is the reason why we do this, because of the potential savings and risk without really having to give up a whole lot of return. All right, well, anyway, I better save this before we lose it. Because, you know, that's exactly what's going to happen. All right, let me just put this away. This is a portfolio example. Okay, so that way we're not going to lose that. And anyway, so what needs to be done still? There's a couple of more topics I want to look at here. So I think, I don't know about you, but I really could use a little bit of a break. So we'll stop for, let's say, 10 minutes, maybe 15 at the most. I just want to quickly wrap up these last couple of topics. This one in particular, because it explains how options get involved. And then what we're going to see is expected shortfall, which we mentioned earlier, is a way of increasing our understanding of what's happening in the left tail of our distribution. So we'll stop for about 10 or 15 minutes. And when we get back, we'll just wrap this up. And so I think we'll finish in time. But you can see this is an extremely important area, because this is sort of explaining to us why we use these hedging instruments in the first place, to help achieve these huge risk reductions whenever possible without necessarily giving up a lot of return. All right, so I'll be back in a bit, 15 minutes. All right. All right. So now here's what's going to happen with the options. The value risk of an option is going to be very tricky to calculate no matter how we look at it because of its nonlinearity. So what we will be doing is using its delta as a measure of its risk, because we know that delta is defined to mean that it's how much does the option price change when there's a given change in the stock price. So this is one way we could actually use the delta to help us calculate the VAR of an option. So we have an option, IBM 100 call options with a delta of 0.6. Each one is 0.6. The stock is selling for $50. Its annual volatility is 30%. We also have in our portfolio 50 GE call options, each with a delta of 0.72. And that stock is selling for $80 a share with a volatility of 20%. And finally, we need to know the correlation between the stock's returns, 0.5, which is pretty normal for two US stocks. Like I said before, about 0.33 or 34 is the average, because all American stocks to a certain degree are affected by the US business cycle. So you can't expect, not realistically, to find two American stocks with very negative correlations. I mean, I suppose they could exist, but it's going to be a hard find. Most of them will be slightly positive. So anyway, this is the formula that we're going to use. Okay, here we go. So what we're going to try to do is estimate what would happen to the price of this portfolio for a given change in the stock prices. So we're introducing this new variable here. This is delta, actually. This is the lowercase delta in the Greek alphabet. And basically, we're doing it this way to avoid confusing it with this delta. All right, because delta, you know, there's two different deltas. This triangle is the uppercase delta. This is the lowercase delta. So we're going to use this to represent the sensitivity of the option. It's actually, in this case, the sensitivity of the entire portfolio to the change in IBM. So you can think of it as a portfolio delta rather than the delta of the individual stock. Now, the reason why we need to do this is because if there's a change in the price of the IBM stock is correlated with the GE stock. It could have an impact on the GE stock as well as the IBM stock. So that's why we need to consider this at the portfolio level rather than the individual levels. And so, and then these are the returns to the individual stocks. So think of these as, like I said, delta 1 is the change in the portfolio value due to a change in IBM. Delta 2 is the change in the portfolio value due to a given change in GE. The rates of return are simply percentages changes in the stock prices. So the change in the portfolio value comes from the change in IBM plus the impact of the change in GE. So now we don't know what delta R1 and delta R2 just yet. Those are the rates of return to the two stocks. But what we do know is the number of shares that we have, the delta of the stocks. So notice, why is this here? Because if each IBM stock has a delta of if each IBM option has a delta of 0.6 and there's 100 options, that implies a total delta of 60. The stock price is currently selling for $50. The product of these two will tell us the dollar value of the change in the stock's price. Okay, in other words, if you multiply the rate of return to IBM by the $50 stock price, these two terms will end up telling me what is the change in the value of the stock. Okay, whereas this is the delta of all 100 shares of IBM. And so over here for GE, we have something similar. So basically, the change in the portfolio value is 3,000 times the rate of return to IBM plus 2880 times the rate of return to the GE. Now, by the way, one thing we have to watch out for here is that volatilities are normally quoted on an annual basis. If we're trying to figure out a daily VAR, we have to use the square root of time rule to convert these annual vols into daily vols, which means this time we're not multiplying by the number of days, we're dividing. Okay, so in other words, an annual vol of 30% for IBM, when we divide by the square root of 252, leaves us with a daily vol of 1.89%. And similarly for GE, we're taking an annual vol of 20%. When you divide that by the square root of 252, it leaves us with 1.26%. Well, anyway, this is the square root. This is actually meant to be the standard deviation of delta P. And that is going to be what we're going to use in our formula. In other words, what is the volatility of the portfolio's change? $81.17.4, which will take the place. Let's go back and grab the original formula. Just so I can show you, this is slide 62. Let's go get the formula so we can see how they stand next to each other. Here we go. So basically what's happening is that this number is, I'm going to actually rearrange this slightly because of the way they've done it here. The negative 81.174 takes the place of the dollar value of the portfolio times the standard deviation, because that's essentially what it is. Then this is the quantile or z-score. And so we're left with 133.53. But if you prefer, as we saw earlier, what you can do is calculate the individual VARs for, in this case, IBM and GE, and then plug them into that formula with the understanding that the correlation between them is 0.5. Okay, and it has to be the same. Okay, so this is kind of an interesting approach because they're essentially what they're doing is converting the stock option into a linear security. The formula here, you notice how it doesn't have any square terms or anything like that. It's an approximation. That's the best we can do because remember, VAR is essentially based on the assumption that risk is linear. So we have to approximate that whenever possible. Now, this is the one I really wanted you to see. The problem we mentioned earlier is that the VAR only shows us the threshold of that left tail. It doesn't say anything about what could happen. Okay, what happened? Oh, this is the end of the document. Okay, good. I thought we'd lost a lot of work. Okay, that was going to be very annoying to me. What I wanted to say is that we're looking at the left tail, the normal value at risk. So if you just imagine drawing a picture of the left tail, let's say 5% tail. Okay, so we don't know what's happening inside. So the 5% VAR is basically this distance. With the expected shortfall, here's what we're going to do. So remember we saw before the 5% VAR, is just the difference between the mean and that left tail, the starting left tail. So what we're going to do with expected shortfall is we're going to calculate 96% VAR and it could be anything you want. You could have, for example, 95 or 5% VAR rather, and then the next one would actually be 4%. 4% VAR. You should be looking at the left 4% tail, and then 3% VAR, and then you could have 2% VAR and 1% VAR. So you're slicing up the left tail basically. And then you're averaging them out. Okay, so 5, 4 reaches us down to here. 3, 2, 1, and then you average them out. So in other words, what it's doing, expected shortfall is an average of the VARs in the left tail. So this has the advantage of taking into account what is actually happening in the entire left tail, not just the threshold to the left tail. In other words, you're not just saying where's the, it's like you're basically saying instead of where's the border to the next state, you're basically showing what's happening at these different locations, I guess. And so in the example here, what we're going to do, and we're just making these assumptions that these are the actual VARs. We know how to calculate VAR. We don't have to do this again. What the only thing that's changing for these VARs, by the way, is that Z-score. Okay. The value of the portfolio isn't changing. The volatility isn't changing. So in other words, why are these all so different? It's the Z-scores that are doing it. Okay. In fact, why don't I show you in our spreadsheet what they would look like? So we'll have the left 5% tail, 4, 3, 2, and 1. Okay, so this is your Z-score. And so you're going to have equals norm dot S I and V, and this probability. And so you see how it's getting bigger. And if you assume, although it doesn't say, all right, let's make up some numbers. Suppose that the value of the portfolio is $1 million. Okay, so let's just keep that. Let's say the volatility on a daily basis is, 1% is fine. And that would be the same for every case. And so the VAR for each of these cases is the product of these three numbers. I'll use a negative here to get rid of that negative sign. And so these are the 5 VARs that I would get. And the expected shortfall would just be the average of these 5. So in other words, you would have, instead of 16,448.54, you would have 19,312. And so what it basically means is that instead of just saying, well, the left 5% tail starts at 16,448.54, what you're basically saying is that if I do this all the way into the 1% tail, the average that I find is 19,312.86, which is probably a better measure of how much risk is really involved when we get into that left tail than the 16,448.54. And it has other useful properties as well, very technical properties. But it often, what's now happening is that what places, companies are doing is when they publish a VAR number, they also publish the expected shortfall next to it. So you get a better sense of what this number is really telling me. So in other words, you can see how knowing both is going to be more helpful than knowing just one of them. Now, to the extent that this vol increases, the difference between these two will just grow even bigger. So like if I change these all to twos, then the difference will become even greater. So now, it's an extra 6,000 something instead of just not even 3,000. So the more volatile the stock is, the more important this really is, because as you have a higher volatility, you're going to get further and further out into that left tail. And so it starts to matter even more if you understand what's going on out there. And so this number is what we mean by expected shortfall. So it's a very good supplement to the value risk measure, because it does in fact take a look at what's going on in the tail, which value risk by itself does not. And this was not originally thought of by JP Morgan at the time, because it was such a new idea that nobody really understood what potential problems they could run into. But of course, researchers later on realized that we need something else, and that something else is often just expected shortfall. Okay, so now I also had put together, and I guess we're running out of time here. If you look at all the spreadsheets I sent you, there's one in here that specifically says expected shortfall example. And so it's pretty much the same thing as I just did here. It's just different numbers. In fact, oh, you know what it is? It's that example we had a little while ago. And plus, yeah, there it is. This ties together everything we did: the undiversified, diversified, and benefits of diversification. And we also here have the table of these VARs so that we can calculate the expected shortfall. So this is a nice example here. And you can see it's only the z-scores that are really different for each of these different calculations. The value and the standard deviation are not going to change. So that's there. So of course you can't download it off of Brightspace. You have to use the one I sent you. And is there anything else here that I think there was? I did put together a normal distribution example in case you want to look at that more closely. It's more discussion about how value risk is calculated. And the time, the square root of time rule, how that works, if you want to read through this more carefully. But we obviously didn't have time to do all of this. We covered all of this. These are just more examples. And what else? Is there anything else we left out? No, I don't think so. I think we pretty much got through everything. That's cool. All right. So sadly, we have to call it off right here. That's it. We're done with everything. So I'll just run through all of your homeworks, and we'll put some grades together, and I'll send you out the solutions so you won't wonder what happened. And that should all be done by the weekend. And then I don't know.
Would you mind if I ask you one final question?
Sure. What's that?
I was just wondering, like, how the derivatives play into this, and if a fund manager can use options or derivatives, wouldn't that lower their cost versus like balancing with like stocks? Wouldn't that cost them a lot more than using the options?
It depends. The options can get very, very expensive if you buy them deeply deeply in the money. It really is going to depend on what you're trying to hedge against and which options you end up buying, because the options, like I think I showed you on the first night, those Apple options. Let's take a quick look at that list. Now, by the way, if you're using some hedging strategies, you're buying some options and selling others. So it may not be quite as expensive as all that, but I just want to make the point here that options can be sometimes terribly expensive. And remember too, that these do not last for very long. So in other words, if you're trying to hedge for like a year, let's say, then it starts to become iffy for options, because many of them have maturities that are a lot less than that. So, all right, let's just quickly review or revisit Apple. Jesus Christ, what was that? Is that what I asked for? I don't think so. See, the problem with this Yahoo.Finance has got so many ads that you're going to be constantly batting them away. This is unbelievable. This is just not, it makes me want to move to a desert island. You know what I mean? I just get so tired of this crap not working. Oh, for sake. Yeah, okay. Now that the ads are done, maybe it'll actually allow me. All right. I I think we're beating our heads against the wall here. Oh, here we go. All right, so today's price was 158. So if you look at some of these with incredibly low strikes, like this one with a 50 strike, the actual price of this option is $108.55. So these can be unbelievably expensive, but then these ones that are deeply out of the money are quite cheap. So what strategy you pursue will depend on what exactly you're trying to hedge against and what combination of options you're trying to put together. Because like I said, some of those strategies we saw, the purpose of them was to save money by buying some options and selling others. So each situation is going to be a little bit different as far as cost is concerned. But one thing we do have to keep in mind is these options have relatively short lifetimes. So if we're trying to hedge for the long run, that might not be the way to go. So anyway. All right. So yeah, everything now, by the way, I don't know how long you'll continue to have access to the Brightspace. So whatever you want, you should download it tonight or soon. But I'll tell you what, if let's say you forget and you get to go to download it and it's already gone, you can send me an email and I'll forward you whatever you're missing. Okay. I won't forget who you are. I'm not going anywhere. You can always send me an email and say, "Oh, please, I forgot about chapter 8, or I lost this spreadsheet, or what can I do?" Yeah, it's fine. Just send me an email and I'll take care of it. Well, all right then.
I have a question about the
Sure.
assignments. You
Yes.
said that there were 6 assignments. I remember
Oh, were there? Oh,
only
maybe there
submitting
were five. You know
five.
what? I think you might be right. There were 8 weeks. Yeah, you're right. There were 5 of them. You know what I was thinking? The last one was from week 6. That's why I was thinking 6. You're right. It was only.
Okay, sure.
Yeah.
Just want to confirm that I didn't miss
Yeah.
anything.
No, you're right. I'm glad you mentioned that. Yeah, it was definitely 5. So, yeah, if you've got them all in, that's fine. Now, if you haven't, you can still send them in. I think, like I said, I probably won't be able to put any grades up until the weekend anyway. So if somehow you've fallen behind, you can keep sending homeworks to me until the weekend, and then I'll just gather them all up and do them all in one shot. And that'll be that. Okay.
Thank you.
Now, if I go through my records here and I find that I can't find one of yours, I'll just send you an email and say, please resend it. It does happen once in a while. You know how stuff can go into your junk box and it only stays there for a certain length of time. So if you get an email from me, it might be that for some reason I can't find, for example, week number 3, and then I might need you to resend it. But other than that, we should be fine.
Sounds good. Thanks.
All right, good. All right, anyone else? So I don't know if they have any other more advanced derivatives classes or not. I only do this one. So, but you might find that this material overlaps into your other classes. And so that would actually be very helpful that you have a solid background here, because it is a very quantitative discipline. And so the more background you have, the easier it will be to follow whatever applications they're using them for in your other classes. So there's a lot of benefits to this. And plus, when you read in the financial press, you know, what's going on, you know, sometimes derivatives do get themselves into the news, and you'll have a better feel for what they're talking about. So anyway, I'm gonna post everything we did tonight, and then, like I said, I don't know what the cutoff point is, but you can feel free to write to me if you missed anything. All right. So I'll wish you all a good night.
Thank you. Good night.
And
Okay.
All right.
thank you.
Thank you.
Thank
Take
you.
care.
You're welcome. Bye, everyone.
Bye.
Bye.
Bye.